Imagine spending over a decade, hundreds of millions of euros, and the reputation of an entire continent's tech ambitions on a machine that its own creators admit might never actually work at scale. That's not a thought experiment. That's exactly what just happened on the Nasdaq stock exchange, and almost nobody's talking about what it really means. Let's rewind for a moment and set the scene, because the details matter here more than the headlines suggest. In a quiet corner of Espoo, Finland, just outside Helsinki, a company called IQM Quantum Computers had spent years building what it called a full-stack quantum computing platform. That means it wasn't just writing software that runs on someone else's machine. It was building the physical qubits, the superconducting chips, the control systems, and the cooling infrastructure required to make a quantum computer function at all. This is one of the hardest engineering problems on the planet, and IQM had staked its entire identity on solving it from the ground up, the same way IBM and Google have tried to do, but with a distinctly European flavor rooted in academic research rather than Silicon Valley venture capital. IQM was founded in 2018 as a spin-out from Aalto University, one of Finland's top technical institutions, working alongside the VTT Technical Research Center. For years, it operated the way most deep tech startups do. It raised private funding rounds. It built prototypes. It slowly signed up research institutions and government labs as customers. It became, quietly, one of the most prolific quantum hardware vendors in the world, eventually placing more physical quantum processing units across more countries than IBM or any of its American rivals. That's a genuinely impressive feat for a company most people outside the physics and finance world had never heard of. Then came the moment that was supposed to be a crowning achievement. On July 2nd, 2026, IQM went public. Not through the traditional route of an initial public offering, but through a SPAC merger, a special purpose acquisition company deal that took the company onto the Nasdaq exchange in the United States under the ticker symbol IQMX. The valuation attached to this listing was roughly $1.8 to $1.9 billion, an extraordinary number for a European deep tech company that most of the public had never interacted with directly. It was being described accurately as the first time a European quantum computing company had gone public, a genuine milestone. The kind of headline that European tech ecosystems, often accused of lagging behind American and Chinese innovation, had been desperate to write for years. And for a brief moment, it looked like exactly that story was unfolding. Finland's sovereign wealth fund, Tesi, was expected to continue supporting the company. A secondary listing was planned for Nasdaq Helsinki, symbolically tying the company's success back to its roots. IQM's leadership spoke with real pride about being first, about proving that European deep tech could compete on the biggest stage in the world, the American public markets, without abandoning its European identity in the process. But something strange happened on the day of the listing. The shares didn't pop. They didn't even hold steady. For most of the trading day, IQM's stock traded below its own IPO price. In the world of public offerings, that's not just a disappointing debut. It's a signal, one that professional investors read instantly and instinctively. A lukewarm reception like that usually means the market is pricing in real skepticism, not just short-term jitters. So what caused it? It wasn't a scandal. It wasn't a technical failure. It wasn't a competitor announcement stealing the spotlight. It was something buried deep inside IQM's own regulatory paperwork, the prospectus filed as part of the SPACI transaction. Somewhere in that dense legal document, in the section, companies are required to disclose material risks to potential investors. IQM's lawyers had written a sentence that would end up defining the entire news cycle around the listing. The company stated, in essence, that large-scale commercial traction of quantum computing technology may never occur. Read that sentence again, slowly, because it deserves to be read slowly. This is not a company hedging about near-term delays. This is not a disclaimer about market conditions or competitive pressure. This is the company that just became the first publicly listed European quantum computer manufacturer, telling its own investors, in writing, under legal obligation to be truthful, that the entire technological premise it has built its business around might simply never pay off. Not might take 5 extra years. Not might cost more than expected. Might never happen. Ever. It's worth sitting with why that statement landed the way it did, because on the surface, it might sound like corporate boilerplate, the kind of overly cautious language that lawyers insert into every prospectus to protect against future lawsuits. And to be fair, there's some truth to that framing. Every company going public through a SPAC or an IPO includes forward-looking risk disclosures, and quantum computing companies in particular are required to acknowledge the technology's uncertain timeline. In that narrow sense, IQM's disclosure wasn't unique. Every other quantum computing company on public markets, from Rigetti to IonQ to D-Wave, has similar language buried somewhere in their own filings. But the difference here is context and timing. IQM wasn't quietly filing paperwork in obscurity. It was actively marketing itself on the day of its public debut as the vanguard of European quantum ambition, the proof point that the continent could compete with American tech giants. And in the very same breath, in the very same legal filing that investors were supposed to read before buying shares, the company was telling them that the core premise of its business model might collapse entirely. That contradiction between the marketing narrative and the legal disclosure is what turned a routine risk disclaimer into a headline that rippled across financial media. To understand why this matters so much, you have to understand what quantum computing actually promises, and how far away that promise still is from being fulfilled. Classical computers, the ones sitting in your home, your phone, and every data center on the planet, process information using bits, which exist in one of two states, a 0 or a 1. Quantum computers use qubits, which can exist in multiple states simultaneously thanks to a strange property of quantum mechanics called superposition. In theory, this allows quantum computers to explore many possible solutions to a problem at once, rather than working through them one at a time, the way classical computers do. For certain categories of problems, ones involving massive combinatorial complexity, like simulating molecular interactions for new drugs, optimizing global logistics networks, or breaking modern encryption, this theoretical advantage could be staggering. Google has claimed, using a chip called Willow, that its quantum computer completed a calculation in under 5 minutes that would take one of the world's most powerful supercomputers longer than the age of the known universe to finish. Microsoft has claimed breakthroughs with something called a topological qubit, a chip design meant to combine the stability of classical semiconductors with the strange properties of quantum superconductors. D-Wave has claimed to solve a real-world optimization problem in minutes that would have taken a classical system millennia. These are extraordinary claims, and in narrow, carefully chosen circumstances, some of them appear to be true. But here's the problem, and it's the exact problem IQM's prospectus was quietly admitting to. All of these breakthroughs exist in extremely narrow, often artificially constructed scenarios. They are proof-of-concept demonstrations, not products. None of these companies, including IQM, has demonstrated that quantum computers can reliably outperform classical computers across a broad range of real-world commercial tasks, the kind of everyday practical work that businesses actually need done, at a cost and reliability that makes economic sense. The industry has a term for the moment when that finally happens. It's called quantum advantage, sometimes quantum supremacy, and depending on who you ask, we are either years away from it, decades away from it, or possibly never going to reach it in any economically meaningful way. That uncertainty isn't a minor technical footnote. It's the entire ballgame. Because right now, quantum computing companies are being valued not on the revenue they currently generate, which is often modest, but on the promise of what they might generate once quantum advantage arrives. IQM, to its credit, does have real customers. It grew from 8 customers in 2024 to 22 in 2025, including its first private sector clients alongside research institutions like the VTT Technical Research Center in Finland and the Leibniz Supercomputing Center in Germany. Those are genuine paying relationships, not vaporware. But those customers are largely using IQM's machines for research, simulation, and experimentation, not for solving problems that classical supercomputers couldn't already handle more cheaply. In other words, the business today is built on selling access to cutting-edge science, not on selling a proven competitive advantage. It's also worth noting that quantum computing isn't the first transformative technology to face this exact credibility problem, where the underlying science is genuinely real and the demonstrations are genuinely impressive, yet the timeline to practical, everyday usefulness keeps sliding further into the future with each passing year. Nuclear fusion energy has followed a strikingly similar arc for decades, with researchers achieving real, measurable breakthroughs in laboratory conditions, only for commercially viable fusion power plants to remain perpetually described as being 20 or 30 years away, no matter which decade you happen to be standing in. Self-driving cars followed a comparable pattern for much of the past 15 years, with early demonstrations suggesting full autonomy was right around the corner before the actual engineering challenges of handling unpredictable real-world conditions proved far more stubborn than early optimists expected. Quantum computing risks following that same well-worn path, where genuine scientific progress continues steadily in the background, even as the specific promise of imminent world-changing commercial impact keeps getting pushed just a little further down the road. The difference this time is that public market investors, unlike research grant committees or patient venture capitalists, tend to have much shorter attention spans and much less tolerance for open-ended timelines measured in decades rather than quarters. This is precisely why the prospectus language mattered so much. Investors buying into IQM on the Nasdaq weren't just buying a share of a hardware company with a growing customer list. They were buying a bet on a technological transition that has been promised for over a decade and has repeatedly slipped further into the future every time experts have tried to pin down a date. And now, the company itself, in a legally binding document, was telling them that the bet might never pay off at all. It would be easy to single out IQM as uniquely troubled, but that would misread the situation entirely. This warning applies to every company in the quantum computing sector, publicly listed or not. It just happens that IQM was the first European company forced to say it out loud on the exact day the world was watching most closely. And if anything, the honesty should probably be read as a point in the company's favor, not against it. IQM didn't hide the risk. It didn't bury the caveat in vague language designed to slip past regulators. It stated plainly, in terms any careful reader could understand, that the foundational premise of its business carries existential uncertainty. In an industry known for breathless marketing claims and headline-grabbing demonstrations, that kind of candor is genuinely rare. Still, rare candor doesn't change market psychology. And the market's reaction on listing day tells you almost everything you need to know about how professional investors are currently pricing quantum computing as an asset class. It's being treated less like a mature technology sector and more like a long-dated call option, a bet with a small stake and a potentially enormous payoff, but one that could also expire completely worthless if the underlying breakthrough never materializes within a useful time frame. That framing explains a lot about why IQM's debut fizzled rather than soared. Long-dated options don't typically pop on day one. They get bought quietly by people willing to wait years, sometimes decades, for a payoff that may or may not come. Zoom out even further, and this single prospectus sentence becomes a window into a much larger story about the entire global quantum computing race, and specifically about where Europe stands within it. On paper, Europe actually looks surprisingly strong. IQM alone has placed more physical quantum processing units across more countries than IBM or any Silicon Valley competitor. French company Pascal, working with a different quantum architecture based on neutral atoms, has already shipped several working quantum computers and has additional units in production. Companies in Austria, including AQT and Parity QC, both spin-outs of the University of Innsbruck, have won major government contracts and demonstrated record-breaking technical milestones, including the largest quantum Fourier transform ever performed on a superconducting chip. Dutch company Quantware recently closed the largest private funding round ever raised by a dedicated quantum processor company. By pure hardware output and technical achievement, Europe is not lagging behind. In many respects, it's leading. But hardware achievement and market dominance are two very different things, and this is where the European quantum story gets genuinely uncomfortable. Despite all of this technical output, the aggregate private market valuation of Europe's most mature quantum computing companies, more than 30 of them combined, adds up to something in the neighborhood of 6.7 billion euros. That sounds like a large number until you compare it to a single mid-cap American technology company, at which point it starts to look almost modest. Meanwhile, American quantum companies operating on public markets, or backed by permanent corporate balance sheets rather than time-limited venture capital funds, have reached individual valuations far exceeding that entire European total. Quantinuum, majority owned by Honeywell, raised $600 million in a funding round that valued it at $10 billion, and has since filed to go public at an even higher valuation. D-Wave and Rigetti, both publicly traded in the United States, carry market capitalizations in the billions of dollars each. This valuation gap isn't just a curiosity, it has real strategic consequences. European venture capital tends to operate on shorter fund cycles than American investors are willing to tolerate, often around 10 years, with internal pressure to show returns well before that deadline arrives. Quantum computing, by almost every expert estimate, requires research and commercialization timelines stretching 8 to 12 years, sometimes longer, before meaningful revenue becomes possible. That mismatch between how long the technology actually takes to mature and how long European investors are structurally willing to wait creates a dangerous pattern. Promising European quantum startups get pushed toward acquisition or exit, not because the technology has failed, but because the fund clock is running out, regardless of whether the science is ready. American competitors, sitting on much larger balance sheets with no fund expiration pressure, have been more than happy to step into that gap. Google has already absorbed a company called Atlantic Quantum. IonQ acquired 5 companies in the past year alone, including the acquisition of UK-based Oxford Ionics, which became the largest exit in the sector's history. A different American semiconductor company came close to acquiring French startup Quably before talks eventually stalled. The pattern here is not subtle, and it's not new either. It closely mirrors what happened in the semiconductor industry during the 1980s, when more than 200 chip companies existed before the entire sector eventually consolidated around a handful of dominant players, largely American, with Intel and eventually Taiwan's TSMC emerging as the industry's gravitational centers. It also mirrors what happened during the artificial intelligence boom of the past decade, when thousands of AI startups launched around the world, only for the enormous majority of the resulting economic value to accumulate inside a small handful of companies, most notably NVIDIA on the hardware side and OpenAI on the model development side. If that historical pattern holds true for quantum computing, and there's little reason so far to think it won't, then Europe's current hardware lead may end up being a temporary and somewhat fragile advantage, rather than a durable strategic position. The companies doing the most impressive engineering work today could very plausibly become tomorrow's acquisition targets, absorbed into American balance sheets the moment quantum advantage starts to look commercially real, at which point the actual economic value, the intellectual property, the talent, and the long-term profits would flow primarily toward whichever country's companies did the acquiring, not necessarily whichever country's scientists did the inventing. This is precisely why the timing of IQM's public listing carries such political weight, beyond just the financial story. The listing happened against a backdrop of accelerating government interest in quantum technology on both sides of the Atlantic. In the United States, recent executive orders have pushed to accelerate national quantum timelines, and the Department of Energy has committed to deploying what it calls the world's first fault-tolerant, scientifically relevant quantum computer by 2028, an extraordinarily ambitious target given how far the underlying science still has to travel. IQM itself stands to benefit from this American push, having already established a quantum technology center in Maryland and deployed one of its own machines at Oak Ridge National Laboratory, a flagship Department of Energy research facility. In a strange twist, the company that just admitted quantum computing might never achieve large-scale commercial success is simultaneously deepening its ties to the American government agency, racing hardest to prove that exact claim wrong. Europe, for its part, has not been sitting idle. The European Commission has rolled out a sweeping quantum strategy, funding 6 quantum chip pilot factories and launching a continent-wide skills academy aimed at training the next generation of quantum engineers and physicists. Since 2018, European governments have committed more than 11 billion euros in public funding toward quantum research and infrastructure. And yet, despite that enormous public commitment, Europe still attracts only around 5% of global private quantum investment, compared to roughly 50% captured by the United States. Public ambition and private capital are simply not moving in sync, and that gap is exactly the vulnerability that American acquirers are positioned to exploit. There's also a less discussed, but arguably more consequential dimension to all of this, and it has nothing to do with stock prices or venture capital fund cycles. Quantum computing, if it ever does deliver on its most extreme promises, wouldn't just be a commercial technology. It would be a strategic one, with implications for national security, cryptography, and critical infrastructure that go far beyond drug discovery or financial modeling. A sufficiently powerful quantum computer could, in theory, break the encryption standards that currently protect everything from banking transactions to military communications to personal data stored across the internet. Whoever controls the underlying quantum stack, from the cryogenic hardware at the base layer up through the error correction software that keeps qubits stable, will have significant influence over the security architecture of the next era of global computing. That's precisely why some analysts describe this as more than just a commercial competition between companies. It's a quiet extension of the broader technological rivalry between the United States, China, and Europe, playing out through corporate balance sheets, SPAC mergers, and dense legal filings that most people will never actually read. Which brings us back to that one sentence buried in IQM's prospectus, the sentence that started this entire story. Large-scale commercial traction of quantum computing technology may never occur. It's tempting to read that line purely as bad news, a warning sign that the quantum computing hype cycle is finally colliding with reality. And to some extent, that reading is fair. Venture funding for quantum startups fell by nearly 40% in 2025, compared to the year before, as investors grew increasingly cautious about long development timelines and uncertain paths to profitability. IBM has already scaled back some of its own quantum roadmap projections. Google, despite its headline-grabbing demonstrations, still hasn't delivered the kind of transformative, broadly applicable use case that would justify the scale of investment currently pouring into the sector. But there's another way to read that same sentence, one that's arguably more useful for anyone trying to understand where this industry is actually headed. IQM's admission wasn't a confession of failure. It was an act of unusually blunt honesty in an industry that has, for over a decade, been characterized by relentless optimism, breathless press releases, and headline-friendly demonstrations that often obscure just how far the technology remains from practical, everyday deployment. By stating the risk so plainly in language, investors could not possibly misunderstand. IQM effectively forced a conversation that the entire quantum computing sector has been avoiding for years, the uncomfortable possibility that all of this investment, all of this engineering brilliance, all of this government funding might ultimately lead nowhere close to the transformative future that has been promised. That kind of honesty carries real value, even if the market didn't reward it with a rising stock price on day one. Public markets function best when companies are forced to disclose real risks rather than hide behind marketing language. And IQM's prospectus did exactly what securities regulations are designed to make companies do. It gave investors the information they actually needed to make an informed decision, rather than the polished narrative the company would probably have preferred to tell. Whether that transparency ultimately helps or hurts IQM's long-term valuation remains to be seen, but it does set a precedent for how future quantum computing listings might be scrutinized, both by regulators and by increasingly skeptical public market investors, who have grown weary of long-dated promises that never quite arrive on schedule. So where does this leave the broader quantum computing story and Europe's place within it? The honest answer is that nobody actually knows, and that uncertainty is precisely the point. Quantum computing might still deliver on its most extraordinary promises within the next decade, transforming drug discovery, materials science, financial modeling, and cryptography in ways that fundamentally reshape entire industries. Or it might continue advancing slowly in narrow and specialized applications without ever reaching the broad commercial breakthrough that current valuations seem to assume is inevitable. Both outcomes remain entirely plausible given what's publicly known today, and anyone claiming total certainty in either direction, whether wildly optimistic or dismissively skeptical, is almost certainly overstating their own knowledge of where this technology is actually headed. What is clear, though, is that IQM's Nasdaq debut marked a genuine turning point in how this industry will be discussed, funded, and scrutinized going forward. Quantum computing has officially moved out of the realm of pure research and speculative private funding and into the unforgiving world of public markets, quarterly earnings calls, and legally mandated risk disclosures. That transition strips away a lot of the comfortable ambiguity that has protected the industry's biggest promises for years. Public investors will now demand concrete evidence of progress, delivery timelines, and revenue growth on a schedule far less patient than the multi-decade horizon quantum physicists have quietly assumed all along. Whether IQM's honesty becomes a footnote in quantum computing history or a defining moment that reshaped how the entire sector approaches public disclosure will likely depend on what happens over the next few years, as more competitors follow the same path toward public listings, and as the promised breakthroughs either materialize or continue slipping further into the future. But for now, one thing is undeniable. On the day Europe was supposed to celebrate its first great quantum computing success story, the company at the center of that celebration looked its own investors in the eye and told them the truth that the entire industry has spent over a decade trying not to say out loud. Quantum computing might change the world, or it might not. And right now, genuinely, nobody, not even the people building the machines, actually knows which outcome is coming. What we do know is that the conversation has permanently changed. Before this listing, quantum computing lived largely in the comfortable territory of research papers, government grants, and carefully curated demonstrations designed to impress rather than inform. Now it lives in quarterly filings, subject to the same blunt scrutiny applied to every other public company, regardless of how experimental its underlying science remains. That shift alone may prove to be the most lasting consequence of IQM's debut, far more significant than whichever direction its stock price happens to move next. Sometimes the most important moment in a technology's history isn't the breakthrough itself, but the instant someone finally admits in writing exactly how much remains unknown.